newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, sitting in for Francine Lacqua this hour. To our top story, Vice President JD Vance says the U.S. government is on track to shut down after a meeting with congressional leaders blaming Democrats just a day before federal funding is set to expire.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
We've had 45 days and 45 days and 45 days and 45 days. We asked to meet earlier, they didn't want to. So we think when they say later, they mean never. We have to do it now, first because of the timing issue, and second, because now is the time we can get it done.
Let's get more on this story. Bloomberg senior editor Balazs Pence joins the program. Balazs, just walk us through what's holding up some of these talks. What's the pain point here?
Well, Kriti, at the center of the issue is healthcare spending. As we have seen so often over the past decade, particularly in this case, the Democrats are pushing for keeping some Obamacare subsidies going. These are subsidies that help keep premiums down for lots and lots of Americans. And they're also trying to reverse some Medicare cuts that the Trump administration enacted earlier. And while we have seen some daylight in these statements that we just heard from JD Vance and from Chuck Schumer, which does suggest that there's some room for a compromise, both sides are very busy kind of framing the debate in a way that would allow them to blame the other side if there's a shutdown, which suggests that we could be in for an end of government funding for the first time in more than 6 years since that historic 35-day shutdown during the first Trump administration, because right now both the incentives and the frameworks and the sort of nature of the debate suggest that neither side is particularly interested in reaching the compromise. Although it has to be said, we've seen this many, many times before. These shutdown negotiations often do go to the very, very last minute. So there could be another solution, but it's going to be a very interesting, very volatile last 24 hours in Washington.
Balazs, the longest shutdown on record lasted about 14 days back in 2019. If we do go into a government shutdown yet again, which seems to be the foregone conclusion by market participants and strategists around the world, as you just outlined, what is the impact on Friday's jobs numbers?
Well, that would be like Christmas being canceled for markets, right? The Jobs Day is always a great, very exciting day for markets. It's a notoriously difficult number to predict. It's a very volatile number, so it's always room for great trading. And it's also a key number, perhaps the most important indicator when it comes to predicting which way the Fed will go. And you have to wonder, if there's no jobs number, how comfortable will Fed officials feel with perhaps continuing with rate cuts when there is still more inflationary pressure in the economy coming from the continuing introduction of more and more tariffs. So that would create a certainly very interesting situation in markets and a very difficult position for the Fed to be in.
Well, Ash, I love that you said that. Christmas being canceled potentially on Friday. The question, I think, for everyone is, who's the Grinch? Is it the Democrats or the Republicans? Balazs Pence giving us the rundown on that story. We thank you so much. Setting us up nicely for our next conversation in terms of how the markets are supposed to play all of this. I'm joined now by Fiotakis, of course, the global head of FX strategy and EM macro strategy over at Barclays. You're in the hot seat today. What does a government shutdown mean for the FX markets?
I think, as you said, for some days or maximum a couple of weeks, we're going to get some uncertainty around the numbers, around what's going to happen with the Fed. And, you know, there might be also some interruption in spending from the government, it could weigh potentially in a couple of numbers. But historically also the case is that once the government reopens, arrears clear, money gets paid back, and then the economy moves on. So while the market will trade, you know, the weaker dollar, the off-risk sentiment and so on and so forth, at some point that will become an opportunity as well. I'm not even sure if this becomes even a tradable sort of like mini cycle or not.
Well, it's interesting that you say that, because if we do get through this iteration of the government shutdown, it looks like when you look at some of the bills that are in Congress at the moment trying to make it through, we're due to revisit this exact conversation in November and in December as well, which I think is a good moment to broaden out for a moment and talk about the fact that a lot of the dollar weakness has been attributed not just to some geopolitical volatility emanating out of Washington, but a lot to do with its balance sheet. So let's talk about the numbers here. When it comes to the U.S.'s fiscal debt issues, should the dollar be trading off that, or are we looking at something else?
I think it's, you're touching on an angle of the story. Obviously there's a pretty big stock of trade, of debt in the U.S. But against that, you have assets of U.S. households and corporates that are 6 or 7 times GDP. So I don't think the issue is necessarily the stock of debt. The main issue for the dollar has been that over the last decade, the ownership of U.S. assets has increased in numbers, basically, right? So 2014, on net, foreigners used to hold $500 billion of U.S. assets. Today, that net number is close to $25 trillion. That ownership being increasing because there's no huge investment alternative to the U.S. There hasn't been for the last decade. And as a result, people are worrying that if the markets lose faith in the U.S., or if markets lose faith in the currency proportion of U.S. investments, they'll take the money out or hedge the FX risk, and the dollar will weaken as a response of government policies. However, we have argued that this line of logic is not without fail, I would say.
Well, walk us through, keep going. I mean, elaborate here, because at the end of the day, one of the key reasons that you're seeing the euro outperform has been this sell America trade as well. But you've seen it rebound in the equity market. You've seen it rebound in the bond market, arguably in the commodity market as well, in terms of, I'll say, WTI and dollar-denominated commodity contracts. Why is the dollar so uncorrelated with the bond market right now?
I would argue that the dollar has been stable since June, roughly speaking. It hasn't rebounded, as you rightly point out, but it hasn't massively sold off. And it hasn't sold off despite the fact that you've had a lot of bad news for the U.S. economy, a lot of noise around Fed independence, and a pretty big widening in rate differentials in favor of Europe, basically, right? So you've had this cyclical shift, you've had this narrative shift in favor of the euro, but the euro has not made progress. Why? First of all, we haven't seen the outflows from the U.S. In fact, very soon, outflows became inflows in a very rapid way as U.S. assets rebounded. Second, we haven't seen the increase in hedge ratios in reality that the market was worried about. People are not hedging their assets, dollar assets in droves. In fact, in our estimates, the amount of hedging that has happened in terms of dollar asset has actually decreased over the last few weeks or months as a share of AUM. And on top of that, you've had a lot of the big pools of assets in Asia being worried about floating their currencies, what I call fear of floating. No one wants a strong currency during a time of trade pressures. And on top of all that, the U.S. economy has done better than people would have expected. And we are about to see an acceleration in the U.S., given easing in financial conditions, given some fiscal stimulation as well. Who knows how much that is, but at the very least, you can make some statement that the worst is likely sort of like behind us. So if you put that all together, you get a sense that maybe some macro forces are pointing to a bottoming out for the dollar.
So due for some strength then when it comes to the greenback. So let's talk about the other side of that currency pair. When it comes to the euro specifically, I'm looking at a 117 handle on euro dollar right now. If we're looking for a rebound in the dollar, does that set us up for kind of a crash to parity when it comes to the euro? And I say this because you talked about this in the context of Asian currencies and the strength being something that they don't love and are actively pushing against. Well, you're seeing the same thing in the euro as well, that a stronger dollar could hit, or stronger euro, could hit the exporters of the continent. How realistic is a parity conversation at this stage?
I think you're raising an excellent point of conversation. I'm not sure parity is what we could be looking at. Maybe something like 113, 115 is something closer to our range of forecasts over the last few months. And mainly because, you've had fiscal stimulus in Europe, so that puts some kind of a floor. There's also this Fed independence concern that is looming. Maybe we have a negative outcome for the Fed in terms of the Cook trial. So all those reasons are probably unlikely to drive the euro much weaker. But what is not commonly understood in markets or commonly admitted in markets that the euro per se is one of the most expensive currencies here. First of all, you've had euro-dollar appreciation on top of tariffs. So European producers since February are now nearly 28% less competitive than they were in the beginning of the year, which is something which is not commonly acknowledged. Second, the euro has increased in value against a lot of its key competitors. Look at euro against Korea, Japan, China. A lot of the industrial nations of the world have kept their currencies stable to the dollar as the dollar was weakening, so the euro has now become a lot more expensive and less competitive to all those currencies. On a trade-weighted nominal basis, the euro is sitting at multi-decade high. And it's not that the European economy is backing this. It's mainly the anti-dollar logic. This is why we don't see a huge amount of upside on the euro per se, and why the euro against trading partners could potentially weaken a little bit from here.
So you're talking about this from a terms of trade perspective. Let's fold in the monetary policy as well. Does the hawkish stance of late, and I say hawkish with a grain of salt when it comes to the euro, but I should say maybe not dovish or overly dovish stance that you're hearing from the ECB, does that basically create a floor under the euro? And if so, where?
For now, it does. Our medium-term forecasts are about 115, I would say. I would say that if you look at what's priced in, the market is pricing very little chance of easing for the ECB. And I do think that if you look at the midpoint of next year, inflation rates will be below target, even in the ECB's forecast. And the ECB's growth forecast is relying quite a bit on the fiscal impulse and the impact it will have on growth. If you had that trade impact that we were talking about on exporters, you could see some risk to the downside. And you can start seeing risks for rate cuts starting to get priced in. Maybe later in time, but that's the direction of risks. I don't see the risk for hikes. There's more risks for cuts in our view, in our house view. So I think from a monetary policy perspective, you know, rates in Europe have widened a lot versus the U.S. or tightened relative to the U.S. And, you know, the pull of gravity, barring aside some kind of interference with Fed independence, which is our big risk for the dollar, is probably for the other direction.
A final question to you on the Fed. If we do see inflation risks skew to the upside, whether that's tariff-oriented, whether that's we don't see an extension of these healthcare costs going into the end of the year, that's going to, of course, hit the U.S. consumer as well. How quickly are people positioned in the market to price in inflation risk come January 2026?
I don't think that the market has its head around that.
Should they?
I think that they should. I mean, our research shows that not the entire sort of like tariff package has been priced in full. So that's one thing. Second, we have had some pretty sort of like soft-ish numbers relative to what the market would have expected. And third, you know, you're pricing in the full gamut of the cuts that we think are likely. So the risks, to your point, if these things materialize, that's the upside. To me, I think all these things are within the daily range of volatility. You get some higher numbers, you can price out some cut from next year, etc. The main question, I think, for the Fed will be whether the market thinks that given growth and inflation, the Fed will be very dovish because of political reasons. That, to me, is the main question.
I think that's the main question for everyone.
Absolutely.
Fiotakis, Global Head of FX Strategy and EM Macro Strategy at Barclays, walking us through the dynamics on both sides of the Atlantic. I want to leave you with a story before we go to the commercial break. BHP shares are under pressure this morning, down about 2.4% in London after Bloomberg reported that China's state-run iron ore buyer has told steelmakers and traders to temporarily halt new purchases from the company. The move expands a previous curb as contract talks with the Australian miner remain stalled. Now, China is the biggest consumer of iron ore, while BHP is one of 3 giant companies that supply the bulk of the material to the country's steelmakers. We're going to watch that price action very, very closely. Coming up, though, we pivot the conversation to what's going on here in the UK. Keir Starmer giving his annual party conference speech later today. UK PM looking to revive his premiership. We're live in Liverpool next. Stick with us. This is Bloomberg. President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. It's unclear, however, if Hamas will accept the proposal, which calls for the group to disarm, relinquish control of Gaza, and release all hostages.
I also want to thank Prime Minister Netanyahu for agreeing to the plan. If accepted by Hamas, this proposal calls for the release of all remaining hostages immediately, but in no case more than 72 hours.
I believe that today we're taking a critical step towards both ending the war in Gaza and setting the stage for dramatically advancing peace in the Middle East.
Let's get the latest on this story. Bloomberg's Dan Williams joins the program. Dan, just walk us through what's in the 20-point plan.
Good morning. Yes, it's basically the modalities of a winding down and ultimately an end of this war, a war that the U.S. president has recast, an end-of-war deal that the president has recast as effectively a peace deal. That would not be peace with Hamas. Hamas won't make peace with Israel. I think the idea is to remove Hamas politically and perhaps pave the way for a future Palestinian government making peace with Israel, perhaps wider peace deals in the Middle East, while regional powers are calmed by the end of this almost two-year-old conflict. So basically, there are immediate issues to be addressed, the step-by-step issues of a release of hostages within 72 hours of both parties agreeing to this deal. If both parties do, that's still an open question when it comes to Hamas. And then longer-term issues such as a staggered Israeli troop withdrawal and efforts to stabilize the Gaza Strip post-Hamas and bring in rehabilitation and reconstruction.
And just walk us through the Prime Minister Netanyahu's comments when it comes to the strike in Doha.
That was a strike just a few weeks ago on September 9th. Bolt out of the blue, quite literally, the Israelis attacked a Hamas delegation, the senior Hamas delegation based in the Qatari capital. They did this in a manner that certainly surprised the Qataris. Apparently the Americans, who have a very large Air Force base there, were given minimal advance notice of this. The effort, it was clear, was to assassinate the top echelon of Hamas as part of Israel's efforts to expedite a military victory against Hamas in the Gaza Strip and elsewhere. That apparently failed. Some junior members of Hamas were killed alongside a Qatari security officer. So not only was this a breach of Qatari sovereignty, a blow to Qatari security, there was also a cost in terms of the life of a Qatari. Now, Qatar is an important ally of the United States, a non-NATO ally is how it's defined. So the Americans have to heed its concerns as they do the concerns of the Israelis. And it's clear that for Qatar to continue to be playing a useful role here, it also hosts Hamas, but it also mediates between Hamas or Israel, or it has done in the past. Quite crucially, for Qatar to get back in that saddle at this crucial juncture, it needed some kind of face-saving overture from the Israelis. It says Netanyahu apologized. Netanyahu's office and the White House do not use that word. They say that he voiced regrets, a slightly softer version of contrition, one that does not necessarily accept culpability. And certainly the Israelis have argued that they had to strike at this group. They were not intending to strike at Qatar or its personnel. It would appear that what was said was enough to clear those decks, to draw a line under this dispute, bring Qatar as well as other major stakeholders in the Arab and Muslim world into this effort to bring Hamas into this end-of-war deal.
All right, Bloomberg's Dan Williams joining us from Jerusalem. We thank you so much for your time walking us through the state of play on this issue. Let's talk about some of the other stories around the world. President Trump has ordered 10% tariffs on U.S. imports of softwood timber and lumber, in addition to levies on kitchen cabinets, vanities, and wooden furniture. It's Trump's latest move to use import taxes to shore up domestic manufacturing. Tariffs are set to apply from October 14th, with some increases targeted to take effect from January. And right here in the UK, the Prime Minister, Keir Starmer, is expected to directly address the threat he faces from Reform UK, telling delegates at the Labour Party conference that the choice is between, quote, decency and division. Yesterday, the Chancellor described Reform's leader, Nigel Farage, as the, quote, greatest threat to working people. Rachel Reeves also reaffirming her commitment to fiscal responsibility.
There are still people who peddle the idea that we could just abandon economic responsibility, cast off any constraints on spending. They are wrong. Dangerously so. When spending gets out of control, when market confidence is lost, That doesn't just show up in some OBR reports and some difficult headlines a few months later. It is felt immediately in the growing cost of essentials and rising interest rates.
Our very own Lizzie Burden is all over this story. She joins us from the conference in Liverpool. Lizzie, just walk us through what else we heard from Rachel Reeves.
Well, Christy, when I spoke to the Chancellor yesterday, I read out Labour's manifesto and the commitments that they made on tax, not to raise income tax, the payroll tax or VAT, and asked her, yes, no, do you stand by that? She said yes, the clearest wording yet that she stands by that. But there's still a bit of room for fudge here. She could, at the November budget, widen the scope for VAT. She could freeze the income tax threshold, neither of which you could say would break that manifesto pledge. But the big question remains, is that enough to raise the £35 billion that our economists estimate she needs to meet her fiscal rules? And what if she needs to spend even more? I asked her, are you going to lift the two-child benefit cap? And she said, I'd love to do more on child poverty when we can afford it. But interestingly, in a later interview with ITV, she signalled that maybe she would be willing to raise the gambling tax. And indeed, you're seeing the impact on the gambling stocks this morning in response to that. And notably, the revenue she could raise from that gambling tax matches the cost, almost, of lifting that two-child benefit cap. So perhaps that'll be the policy surprise that we get from the Prime Minister today, when we know that Labour right now is really caught between the left wing of the party and the bond vigilantes.
And we're not quite done yet. Keir Starmer still has to make his speech later today. What can we expect from that, Lizzie?
Yeah, this is at 2 p.m. We'll hear from the Prime Minister. It seems like he has managed to somewhat tighten his grip on his party. The Mayor of Manchester, Andy Burnham, who'd been out criticising the Prime Minister, walking back a bit of the speculation that he's contending to be the new leader by saying that he's very happy in his job. So the fight, the focus remains now on Nigel Farage's Reform UK party. As you say, the Chancellor talking about reform as the greatest single threat to working Britons. Starmer expected to pose a choice between Labour and Reform in his speech. Decency and division will be the choice that he sets out. The danger, Critty, is that by fighting the right, trying to reclaim populism, he alienates the left wing of his party in this speech.
Bloomberg's Lizzie Burden covering that for us over in Liverpool, of course, at the Labour Party conference. We thank you so much. Coming up on the program, Zijin Gold shining on its Hong Kong debut. We'll have more on the world's biggest IPO since May next, what it means, of course, for the deal volume that we are seeing. This, of course, is on top of the fact that EA, Electronic Arts, the maker of FIFA, also talking about an LBO to the tune of $55 billion. We'll dive into the deal volume story next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Let's get to our top stories this hour. A U.S. government shutdown looming as President Trump and top congressional leaders fail to reach a spending deal. Gold hitting another record on the back of it. And the U.S. President Israel's Benjamin Netanyahu agreed to a 20-point proposal to end the war in Gaza. Hamas has yet to respond. And in the corporate space, UBS warning that planned capital reforms may put the firm's Swiss future in doubt. More on that story now. This is, of course, going to be one of the major movers in the Stock 600. UBS reiterating its scathing critique of Switzerland's planned changes to banking regulation. The Swiss bank estimated to face as much as $26 billion in new capital demands as a result of the proposed regulation changes, now unveiled earlier this year. Bloomberg's Tom Metcalf joins me right here on set. He's all over this story. We know this has been a push and pull between Sergio Armati and the Swiss regulators for quite some time. We know it's moved the stock quite a bit and kind of put these handcuffs around UBS, at least they claim, in terms of competing with some of the deregulation you're seeing in other parts of the world. What is the latest in terms of this struggle?
Yeah, today's very useful, and that's basically UBS's fulsome, full-throated rejection of these Swiss plans. So it's a multi-page report and just very clearly lays out the argument they've been putting forward through various avenues. For them, this is basically just an untenable situation. And you reading through the tea leaves, reading the language, and it's really interesting, but you can certainly pull out from it that basically if certainly what UBS is saying right now is if this stands, then they don't necessarily see a future for themselves, at least in their current shape and form, in Switzerland. So pretty fiery stuff. Of course, we're, as ever in Switzerland, we're many years away from like the sort of the final decisions and stuff like that. So it'll be interesting to see how the two sides continue to sort of evolve their positions. But right now, everyone's looking for signs of compromise, and certainly the language here, the report suggests that at least for now, UBS and the government's official position, they're still very far apart.
But talk to us a little bit about the Swiss side of things. There's still more to do here. There's more intervention that could potentially be had. Walk us through what that looks like.
Yeah, absolutely. So look, it's a parliament, right? And you're going to have various political parties coming in and various sort of constituencies and stakeholders and that which will direct things. I mean, right now, the Swiss government, very much hardline approach, basically going as severe as they can. But what you are starting to see is sort of across the political spectrum, people starting to, particularly against this backdrop of tariffs and Switzerland needing to find its place in a kind of geopolitically fraught world, like, is this the smartest thing we should do? Really put the pressure on one of our kind of global champions. So you've seen one party, the SVP, come out and say, let's find a compromise. And I do think as the months go on, maybe even the years, you'll see sort of that position kind of gradually soften, perhaps from both sides. And, I do suspect there'll be sort of a meeting in the middle.
All right, I'm going to put you on the spot here. What does it look like when this whole saga ends? What comes at the end of it?
So I certainly think there'll be an increased ask on the capital side. So right now, the one that's causing all the contention is, let's call it the $26 billion figure. Let's put right in the middle there, 10, 15 billion. Maybe that's something UBS can kind of live with. And there's an interesting argument as well, just to put the flip side out there, that actually these higher kind of CET1 ratios can in some cases sort of benefit banks up to a point, because obviously they're viewed as like the safe haven. There's, they've got so much sort of reserves to, kind of weather any storm that's coming. But no, I think if you had put me on the spot, let's say 10 billion, and I'll immediately retract from that later.
Yeah, it's like asking what the jobs number is going to be on Friday.
Exactly.
It's like you just throw a number out there and hope it's right. Bloomberg's Tom Metcalf walking us through the latest on UBS. We thank you so much. I want to stick with the world of finance. I think it's fair to say Zijin Gold has jumped in its debut in Hong Kong after the international unit of China's biggest miner raised about $3.2 billion. It marks the world's biggest IPO since May. Bloomberg Steel reporter Manuel Bagori is all over the story. Manuel, just walk me through the details of this IPO.
Akriti, a very, very exciting and large IPO, the biggest in the world since May. We saw a big pop in stock here in Hong Kong today. Obviously, with the backdrop of gold prices going through the roof, that's supporting companies like Zijin Gold and others that are looking to tap markets and sell shares right now. We saw an interesting kind of like theme here too, which was how Zijin and others are attracting international investors. We saw some big names supporting Zijin in the last few days, and that also helped support some of these larger deals. We saw a similar case back in May with CATL, the battery maker as well, that did a second listing in Hong Kong back then for more than $5 billion.
Is this a Zijin Gold specific story? Is this a mining specific story, or is deal making coming back?
Yeah, mining definitely is a hot space. We've seen a lot of interesting deals, capital markets wise, but also on the M&A front. Just a couple of weeks ago, we were very busy also this part of the world with the collapse of ADNOC's roughly 20 billion, 19 billion potential purchase of Santos, which also fell apart. So there is being a lot of interest. I think it's a sector that is definitely attracting interest globally, not just in Asia Pacific. We've seen some large deals also in the US. So definitely one of the sweet spots for deal making this year, both in terms of ECM and M&A.
All right, Manuel, we got to go to my favorite topic. When I was a wee intern at Bloomberg, my very first beat was the video game beat, and EA was part of my coverage arena. Now it's about to go private in a $55 billion leveraged buyout. I've got to say, when I started covering this company, I did not have this on my bingo card. What can you tell us about this LBO?
That's a fantastic story, Kriti. Well, it's a phenomenal deal, right? And it's also a great example of how we are seeing and anticipating larger mega deals. Definitely an interesting one with some private equity firms and also sovereign wealth funds supporting the transaction. We saw the Public Investment Fund of Saudi Arabia, also Silver Lake and Affinity getting together to buy EA out. $55 billion, that's a massive deal. And interestingly also, we saw a $20 billion package from JP Morgan, which is the biggest we've seen so far of such deal. So interesting. I think the expectation is that more and larger deals will come to fruition over the coming quarters. So we're all super excited into the fourth quarter and into 2026.
All right, Bloomberg Deals reporter Manuel Begori walking us through the investment environment on both sides of the Atlantic. We thank you so much for walking us through really just major deals in the last 24 hours or so. Let's stick with that theme. Investment giants, of course, have been grappling with a prolonged slowdown of deal making. I think today might just be the exception to that. There's now talk about a renaissance of private credit in Europe, with the sector's top players keen to diversify away from the U.S. market. You know, we spoke to key players at the EPAM Private Capital Conference in Paris last week about the outlook when it comes to this side of the Atlantic. Take a listen.
Europe definitely is having its moment.
We remain bullish on Europe. Europe looks, oddly enough, quite stable.
What investors like is stability regarding the fiscal regime, so everything that is new, changing, and yes, it can encourage, push the capital to relocate from other jurisdictions in Europe.
Interest rates are lower, GDP is now heading finally in the right direction, and Europe as a continent still needs trillions of dollars of capital to upgrade the existing infrastructure and to build new infrastructure for AI.
Despite all the challenging aging society, a pension system that needs reform, low productivity growth, fragmentation, things are happening, things are changing. There's a real resolve forward to make reforms and to bring it to the future.
That makes for a relatively favorable environment for investment.
For more on the outlook for Europe, I'm joined by Antonio Alvarez III, Europe head over at Alvarez and Marsal. Lovely to have you. Thank you so much for coming. Of course, we're thrilled to have you. You just heard from a series of guests over at the EPAM conference representing the biggest firms in the world, saying that Europe is having a moment. We've been saying that, I want to say, since January 20th of this year. Would you agree? Is Europe having a moment?
I think in certain aspects where Europe is having a moment, you talk about private credit, and Europe has not been a front runner in that. It's been really a U.S. phenomenon. And like most capital market solutions, it takes time and eventually gets over. From our perspective, we're seeing pretty modest to low growth across the European space and the UK. We're seeing weakness in some key industries like manufacturing, automotive. You saw the quasi-government bailout of Jaguar. Rover recently, you saw the Claire's administration. You're going to see other consumer retailers battling inflation, battling tariffs, battling really a paring down of export markets as geographies are kind of retrenching to more localized. So I think from a financial aspect, there's a pull towards Europe and there's an exit away from or a redistribution away from the U.S. over to Europe, hedging bets. And there is a need for that credit. But I also see some fundamental weaknesses in several sectors. Of course, there's positive sectors like AI technology, infrastructure that was mentioned, some aspects of tourism, travel in the southern part of Europe. But I think it's a mixed picture. I wouldn't be so bullish as of yet.
There's a stat that was floating around at the EPAM conference last week that of Mario Draghi's 800 billion euro ask, that 80% of that could be funded by private capital. That, of course, coming from some of the bulls we just heard from. But it begs the question that if we do see a lot of these private players fill that sovereign funding gap that is undoubtedly there, do we start to run into the risk of the fact that Europe's biggest infrastructure, public infrastructure projects are dependent on private funding? Yeah. Is that a risk?
That is a risk. It's also an opportunity because right now the governments, post-COVID, post-financial crisis, have really been expended. And you're seeing that play out right now in the political scheme. You know, we got to cut costs or we got to raise taxes. And there's this back and forth in most major modern economies. And so if there can be a segment of the funding that could be made up by the private sector, I think that's a welcome result for Europe.
How much is the increase of private funds, not just in Europe, but around the world, maybe prolonging some of the zombification themes that we've been seeing when it comes to corporates? If you can't access the public markets, does this prolong that? If you're getting, whether it's credit financing or equity stakes, does this prolong maybe a flush out that the economy or that the business climate is looking for?
There's certainly a number of companies that are stuck. You've seen the exit from the UK financial markets over to the US markets, but the opposite is happening. You're seeing more valuations in the US as opposed to the London market. You're seeing companies like AstraZeneca double list as a hedge against the UK market. So on the one hand, I see sort of a hedging of the UK financial center market, so to speak. Definitely credit is coming in because Europe has not been Europe and Middle East have really been financed by banks. And there's a big opportunity everywhere else, as markets have been becoming more sophisticated, there's a big opportunity for that to be made up by private credit, which is what you're seeing. In terms of the underlying businesses, you see a number of continuation vehicles in private equity where they're stuck.
Yeah.
They can't sell them. So they got to find a novel solution to kind of recirculate that money. You're seeing companies go from public to privatize, because they're just not getting the valuation. So I think it's an interesting dichotomy of, yes, positive signs. Credit can come in, can help boost the economies. But the overall markets that it's underpinning are challenged, and governments are being challenged.
You bring up a key point around the private credit story. A lot of folks are saying that this is going to be, given that it's so new in the financial innovation, ultimately scary and could create some sort of systemic risk, not just in the States, but certainly in Europe as well. There's also a major theme in private markets right now, which is basically the democratization, the access to some of these funds. Does that alleviate some of the pressure when it comes to the exits that GPs are facing from their LPs?
It could. I think we're looking at that right now. We're looking at, are there ways to raise quasi-debt to help continuation vehicles, to help exits, to recirculate? It's a supply and demand. You're always looking for the supply and demand in the financing markets between equities and debt, and most of these funds now can move from equity to debt in a nanosecond.
Yeah. So
mega hedge funds. And so I think you look for the best financing you can get to operate. The underlying basis for financing, though, I think, and we're seeing it. We're seeing in the consulting market, you're seeing stagnation in general consulting market. And we're seeing a growth in our segment because there is a need for operational improvement. There's a need for just not financial solutions, and so I think that's what we're gonna see for the next couple of years.
What opens up the capital markets? What gets people more excited for seeing more days like today, where you do see really two massive deals in one day on two different sides of the world? Are we looking for more rate cuts? Are we looking for stability out of the White House? Are we looking for deregulation? What's the perfect recipe to get these markets opened?
Stability is always the perfect recipe. You heard that and I think the view is Europe may potentially be more stable in terms of a marketplace. If we've learned anything in the last 10 years, there's no such thing as stability. A pandemic can hit, a financial crisis can hit, there could be a weakening of confidence. There's so much geopolitical positive signs coming out of the Gaza peace, negative signs coming out of the Ukraine-Russia situation. You still have this competition between China and the United States and Europe. Any of these factors can trigger, as we've seen in the last 10 years, an event that moves. I don't think any of the sentiment is so hardened today that it's unmovable. It's actually quite fragile.
Yeah.
Because of the different elements that are affecting the economy.
All right. Always a pleasure to have you. Thank you so much for coming on set. Tony Alvarez III, Europe head over at Alvarez and Marsal, joining us around the table. Coming up, we're going to dive into one of the sources of volatility on the show. Vice President JD Vance saying he believes the U.S. government is heading for a shutdown. We'll discuss the potential implications, maybe a way out, coming up next. Stick with us. This is Bloomberg.
Life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin and so on and so forth. And we don't know that, and so there's a whole leg of the equation that we haven't really seen.
PIMCO CEO Manny Roman there saying that the full impact of President Trump's tariff policies is yet to be seen. And that question may, of course, weigh on the prospects for U.S. stocks and the broader markets. Let's pile on top. Vice President JD Vance saying the U.S. government is on track to shut down after a meeting with congressional leaders. Didn't really come to fruition, didn't really yield any results. They go on to blame Democrats just a day before federal funding is set to expire. So how do you play this in the markets? Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income over at Neuberger Berman, has all the answers for us, right? And joining us around the table, thank you for your time this morning. This time feels different, and I feel like those are famous last words because we go through this iteration every couple of months now, it seems. Is there a trade in the bond market?
It's really difficult, right? Because what does this mean for Fed policy? What does this mean for interest rates and those type of things? So the Fed may meet in October without a jobs report and without a CPI report if this extends for a period of time, and it's going to impact the data collection. So the market does have other things that can go on. We get the ADP report later this week. We'll have we get the Adobe price stats type of thing. So the market will have data points. It's just not the official data points in which to extend. But agree, it does feel a little bit more different than some of the other threats that we've had of late.
Well, let's talk about what's at the core of some of these negotiations, which is one of the key sticking points is healthcare policies and whether or not you get an extension of the ACA, which is otherwise known as Obamacare, just for our global audience. Basically, these extensions that expire at the end of the year, if they are not extended, then it increases healthcare costs for millions of Americans. That being said, that is something that is still 3 months down the road. It's a key sticking point for Democrats. If we were to look through the volatility of the fourth quarter that I'm sure is coming, do we need to be pricing in inflation risk come January 2026?
Well, the question is that an inflation risk or is that an economic growth risk, right? Because as you're spending more money on healthcare benefits, does that mean you're spending less on other items? And, we'll have to see how that trade-off plays itself out in terms of growth versus inflation. We had a call yesterday. One of the big investment banks has sort of put like a growth slowdown associated with the shutdown as sort of 15 bips of growth per week, right? So it's not small, but it's not huge either. So for us, in terms of inflation next year, maybe that's a possibility, but does that take funds away from spending on other goods and services?
I'm going to ask a very novice question here. If we do see a government shutdown, there's a political rhetoric in Washington at the moment that says, well, maybe the White House does want to see the government shut down because in theory, it would save money on the U.S. balance sheet. Is that a credible way of framing the conversation for a bond market investor that is worried about outstanding debt?
It really depends on how long it goes on. But, I mean, it's a short-term savings, right, that will probably be made up then as you bring back the furloughed workers, back pay, these type of things. So there's an argument to be said for that, but on the long scheme of things, the debt challenges are greater than a 2-week or 1 month or 1 day shutdown. But again, we've had these things where we felt like we're on the brink and they get solved hours before they happen. And although, look, 2018, 2019 might be a good example, right? We had a 35-day shutdown. And frankly, economic growth in the first quarter was okay. And that was supported by Fed cuts. And we do expect those Fed cuts, to help growth a little bit.
Talk to us about those Fed cuts. Is the market over dovish right now?
So it had been. So it priced the terminal rate below 3%. And now it's sort of back above that. So we're a little bit below 2 hikes or 2 cuts price for this year. probably around 2 is the right number for this year. So the market's sort of straddling around fair value right now.
What changes that narrative? Are we still waiting, as Manny Roman, the PIMCO CEO, says, that the effective tariffs is yet to be seen?
We're really waiting on the labor market, right? If the labor market does deteriorate faster, the Fed's going to cut faster.
Yeah.
If the labor market's fine, the Fed may cut slower. So it's really more about the labor market, we'd say, than anything else.
Let's talk about some of these trades that are permeating through the bond market space. It feels like everyone's favorite trade right now is the bond steepener. You sell the long end, you dive into the short end, you go all in on the Stephen Myron argument, basically, and but in both ways that you play that. Is the steepener trade a crowded trade?
So look, it's been a painful trade for the past 2 weeks for the market, right? As the curve is flattened. It probably feels less crowded than it has been. But, go back to basics. Pick your fair value 5s, 10s, 30s, up, down. And if it results in a curve trade, great. If not, doing a curve trade to do a curve trade sounds smart, but sometimes, causes more losses than needed.
All right, give us a range when it comes to yields here. I'm looking at 4.13 on the 10-year. We were asking someone in the last hour about this. Just how low do yields go if we are pricing in this kind of volatility?
Right. So it depends on two things, one of which is how low does the Fed go? And, there's this tension between greedy, meaning the yield of 10s versus your cash funding, versus what does the fiscal and what does long-term inflation look like? And so it really depends. If Fed settles in around 3%, then maybe we're around fairish to maybe a little bit lower. If the Fed settles in higher, maybe things are a little bit higher. But it really depends on that, whether the market's concerned about greedy and carry or whether the market's concerned about inflation and fiscal.
There is an argument, again, coming out of the White House, that if you see a series of rate cuts, one that would permeate across the yield curve, including on the 30-year, that would actually help alleviate the risk of a housing crisis. We're seeing the opposite right now, and that as we see cuts priced into the front end of the curve, the back end is actually selling off. Again, bringing back to the steepener point. If we do see the 2 cuts you're expecting by the end of the year, does that bring down the back end of the curve?
Again, potentially, yeah. I mean, because again,
even in the face of Fed independence.
Right. Now, even the curve may steepen, right? But 30s may rally less than 5s or 10s in that example. But the long end, in that example, could rally some, right? Because again, you have that gap between your cash funding and what you're actually earning on treasuries.
Robert Dishner, the man with all the answers, senior portfolio manager for multi-sector fixed income over at Neuberger Berman, walking us through the market impact of a shutdown, some of the other conversations in Washington. We thank you so much. A programming note for tomorrow, Bloomberg Television will have live coverage of the Women, Money and Power event right here in our London headquarters, convening the most influential female voices in finance from around the world. We'll discuss key themes facing the future of business with the women at the helm of one of the best firms in the business. Stick with us. This is Bloomberg.